And welcome. This is Mary Ellen McGonigal with your Friday afternoon MEM Edge show. As always, the show where we bring you where the action is in the broader markets. A bit of a sloppy week. We'll get into that. Some key economic data was released. First up, let's talk about it. Consumer price index information came out earlier in the week, and it was stronger than anticipated. We did see interest rates rise, and we also saw some other carry-on impact that I'll share with you today. And also today, more by way of hot inflation data. We did get those PPI number for January, and that came in higher than expected as well. So we definitely did see a little bit of a shift here in the markets. We'll take a look at where we closed for the week, as well as what to be on the lookout for going forward. Retail sales numbers came in. They were their biggest drop in 10 months. Now, we did see some impact on the retail side due to that. However, it is also widely known that those January retail numbers do tend to come in weak after a strong December. So it is the February and March retail numbers that may or may not have more of an impact. We'll keep an eye on that. Also, we did see wholesale costs rise to their highest level in 5 months. And that was all about that PPI data number. Next week, be on the lookout. Wednesday, the FOMC meeting notes will be released. Monday is a holiday. Enjoy your day off. Let's go ahead and take a look at those broader markets and see where they close for the week. And here we are with a daily price chart of the S&P 500. And we did see a pullback take place. This is that move earlier in the week with the CPI data. And then today's half a point pullback on the PPI data. But in the end, that uptrend remains. We're still above this 10-day moving average, your RSI in positive territory, as well as the MACD. However, we did see a bit of shuffling beneath the surface that I will share with you as we move through today. As usual, let's take a look at the S&P 11 sectors underlying. We're going to take a look at a 2-month daily price chart view. And by way of adding an RSI indicator in descending order, this is where we can really get our arms around any sector rotation that may be shaping up. We're looking for where that relative outperformance is up in this upper quartile relative to those weaker areas down here. First up and of note is the fact that technology is down here in the lower quartile. This is XLK, and that is the tech ETF, and it was down 2.4%. Now, when you're looking at these sectors, you will want to be aware of the heavier weighted names that are going to impact the sector more than not, and that is Microsoft and Apple, down 4% and 3.8% respectively. So certainly an impact, but I will share with you another area that had a tough go of it last week as well. Now, despite being in a relatively weak area among its other sector peers, we can see the tech is finding support at this upward trending 21-day simple moving average. We have this RSI trending lower, but it is still above that net neutral 50. So it is something that certainly from my work, I will be talking about quite a bit in my weekend report, which will come out on Monday. You can use that link below to get clued in further. Now, let's take a look at some of these other sectors up here. We did see energy at the forefront, up 3.1%. A lot of that having to do with the price of oil, up 2.6%, and then other dynamics relative to earnings coming in select areas. Also up here at the forefront, take a look, financials after stumbling quite a bit with the regional bank, commercial real estate fear. We did see financials pop, and I would tell you, we will take a look at KRE. That's that regional banking ETF, up 2%. And then also major heavyweight Wells Fargo had very good news with their penalty being removed, which will most definitely positively impact their bottom line. Now, as we move through, you'll want to be aware of some of these other areas down here, staples, utilities, and REIT names. Generally defensive, they have been down in this lower quartile, but you can see that they did have a nice week. They were the top performers certainly basic materials and utilities were. And with that, we can see that the area is still down here in the weaker quartile, but we did see movement into them by way of money flows last week. Basic materials up, XLB up 2.5%. A lot of the metals were on the move higher this week. So that's the sector view. From here, we do want to drill down beyond, take a look at some of the sub-industry groupings within these sectors. Also, one last note here, XLV, which normally is viewed as defensive, but a lot of this uptrending movement here, outperforming the broader markets last week, up 1.3%, is due to growth, and growth in certainly select heavyweight pharmas and other areas that I'll share with you as we move through here. So taking a look beyond these sectors at the underlying industry groups, let's see what is or is not on the move. Again, that RSI descending order. These are ETFs that I find to be super helpful as far as staying on top of, again, where that relative strength versus the weakness is. So first up, let's take a look. Semiconductors. We saw tech got hit down 2.4, but semiconductors holding in, down only 0.5% last week. Uptrend still in place. I'll share with you a couple of names there and why these semis are generally relatively holding up. So moving through XRT, I talked about those retail sales numbers not having a big impact, but overall this group was up 1.1% relative to a negative 0.2 on the S&P. And as you may recall, this is an ETF that I recommended last week as a way to play retail without really drilling down. There's not a whole lot in retail that I'm finding attractive from a fundamental and chart basis. So this ETF is a great way to play the continued move into select areas of retail. Talked about healthcare. Let's take a look. IHI. This is the medical devices ETF, and it's another area that just squeaked out an outperformance above the broader markets, but generally in a nice uptrend. Select names again on my MEM Edge report, both in the medical devices and large pharma, are having a great year-to-date move, poised to trade higher. So let's take a look also among the broader market indices. I did not mention the small cap. This is IWM, Russell 2000 ETF, up 1.5% for the week, and we can see it's continuing to form the right side of the space. Take a look at that MACD crossover, black line up through the red. So a nice movement back into small caps. That is a bright spot in last week's price action. We want to see these small caps participate. They are riskier. It does imply a risk on mentality. And again, can be good news if we see a nice continuation rally. Also taking a look at tech, IGV did not fare well, down 3% for the week. We talked about Microsoft, but there are other areas of weakness here. We can see that RSI trending toward that 50, potentially lower. And if we go back to these pullbacks that shaped up last year in software names, certainly in this September period, again in October, but most pronounced was this July into August, all about a rising interest rate environment. However, this week as well, we saw a number of names in that software space, well known, that came out with not great numbers. I'll share with you one name as long as we're on the topic. We can take a look at SHOP, Shopify, gapping down on weak earnings. Another name that also faltered last week, CDNS. So we are seeing weaker earnings in some of these bigger names that's also impacting, but certainly the interest rate backdrop is going to be critical. Keep an eye on that if you own software names. That's going to be another area of impact. So taking another look back at these ETFs, I want to make sure we covered everything that is certainly notable. Talked about KRE, regional banks. They had a nice week, certainly relative to the markets, up 2%, but still languishing, not an area that I would put money to work. There's too much uncertainty there, certainly relative to the bottom line for some of these regionals that are involved in commercial real estate. And moving through, I talked about healthcare. Here's another area IBB. This is the Biotech ETF, and it did fare well, up almost 1%. And you can see the MACD black line poised to cross up through the red. When we talk about risk on, it's going to be biotech and semiconductors. If we see continued money flows into those areas, that is going to be good news. Now, from here, I also wanted to take a quick look at the Magnificent Seven names. They certainly last year were clear-cut leaders into the beginning of this year. Certainly not that first week, but beyond. However, this last week, we did see a bit of a divide continuing to shape up. So we have again, I'm calling it the FANG, but it is the Magnificent Seven, newly minted. And again, that RSI descending order. So let's take a look up here at the forefront. We have Nvidia continuing to power higher. Let's take a quick look here at Meta. This is Meta Platforms, huge gap up. Both names on my MEM Edge report also included are specific buy points. So if we look at this gap up, this back and fill period of consolidation, very orderly. That's what you want to see. Certainly when a stock is very overbought, both by metrics of the MACD and that RSI. So those are the names sitting here up at that forefront with that relative outperformance. Netflix is another name. I only have 3 of those mega and Magnificent Seven, and here they are. Gapping up, we were in this name before this big gap up on earnings, period of consolidation, and then this week, another leg up, shaping up after that consolidation period, looking quite constructive. Let's go ahead back to this list because you want to be equally aware of those areas that are underperforming. Certainly Apple coming in with numbers that disappointed. You can see it had this attempt to reverse that gap downtrend, not sticking. So hopefully you're not overweighted in Apple. It does not look constructive. Interestingly, Tesla attempting to reverse its downtrend. It was up 3% last week after this gap down, responding to weak quarterly numbers and a weak outlook. And Alphabet. So down here in this lower quartile, these are the names, again, gapping down relative to weak numbers are certainly not as good as was anticipated by investors. We did see this downtrend reversal attempt, which has since failed. We now have negative RSI and the MACD poised to turn negative as well. And then last up, I did want to share with you that concept, and we did see it with Meta and Netflix, that gap up, how one would trade a stock relative to that. So we did have a couple of names, certainly again from my MEM Edge. I only have about 18 on that suggested holdings list, but this, let's see if we can pull this chart up. One of them was SHAK, good old SHAK. And here we are with that gap up yesterday, super big volume. That's going to be a very telling clue. So from here, I will share with you another name from my MEM Edge report that experienced that gap up and how did it perform and behave afterward. This is Deckers. Let's take a look. This is going back 2 weeks ago. Gap up, super big relative volume. And this is what you want to see, at least a bit of a pullback, very orderly back and fill formation, really allowing these overbought conditions to just settle in, give the stock an opportunity to reset before experiencing that other leg up. And this is something I talked about in my report 2 weeks ago. I did suggest that we would do a pullback. So it certainly makes sense given that big move higher. And that's it for this week's show. Everyone have a safe weekend, safer than I had last week when I broke my wrist, undue falling over my little doggo. But enjoy the long weekend, guys. And I look forward to seeing you here next Friday.